Welcome back. Well, as promised, let's get that conversation going on these high US interest rates and whether there's any money to be made for us, for Indian investors, because bond yields are so high in the US. Kaustubh Gupta of Aditya Birla Sun Life AMC is with us now to take the conversation forward. He's co-CIO debt at the asset manager. Kaustubh, great to have you on the show. Thanks for joining in. This conversation is happening at an interesting time because I know you guys have launched one such product that seems to be a play on high rates. But first, tell us this, that, typically markets are very worried about these high bond yields in the US. Do you see an opportunity?
Yeah, thank you, Surabhi, and good morning to your vision. Yeah, look, there has been some bit of unusual moves in across the board developed market bond yields, and the US has been seeing the maximum point of pain. The reason behind it is basically the strong growth than what was initially perceived to be. It's very sticky inflation, very high fiscal deficit that US government is running, and at margins, Fed is trying to push markets to believe in now higher for longer, when compared to 2020, they were pushing markets to believe that rates will remain lower for longer. At the same time, US is also doing some bit of QT by selling bonds actively in the markets, and a lot of foreign central bankers who are usually the large buyers of these United States treasuries, they are now at margin looking to diversify beyond US dollars, given their experience to Russia-Ukraine crisis. Now, all this is culminating into a fair bit of demand-supply mismatch and a lot of uncertainties in USD, and which is why what we have seen is one of the worst drawdown in last 40 years in all these developed market bond yields, and specifically in US. Now, at margin, we do think that compared to what happened in 2023, a lot of things will change in 2024, and somewhere in the middle of 2024, we will enter into a soft patch, which will allow Fed to also cut rates. As of now, Fed is guiding that they are near to peak. Our base case is that US economy slows, and which at margin can create opportunities not only for the tactical investors but also for long-term investors for their allocation.
Okay, so Kaustubh, allow me to ask you this. I think what your premise is that you are expecting rate cuts to start in the US and eventually bond yields to start falling over the next 12 months, right?
Yes. So, there are two things. One is that fundamentally these yields at these prices, they are now way above their long-term neutral rates. And at this price, our view is that they are significantly above their fair real value, which means that once the US economy enters into the soft patch, it will enable Fed to cut rates and support economy. We don't expect very deep rate cuts, but we are of the view that there is a shallow soft patch which is coming in US in middle of 2024, and which is why there is an opportunity for all sorts of investors to invest into USD.
Kaustubh, when do you expect this pullback in the yields to start happening? Because, we did hear from the Fed chair just last night, and what he's emphasizing is a higher for longer kind of situation. May not happen in the November meeting, or it won't happen in the November meeting, but after that, there are expectations. So when do you expect this, yield to start pulling back? And what do you think we can see in the next 12 months? Because that's when you're saying that it should moderate significantly.
Look, what has surprised policymakers is the strength in the economy, specifically in US, and which is why markets have been continuously selling off where they are. Now, when you look at the internals of the data, there are reasonable evidence to understand that the incremental data is pointing towards softness. For example, if you look at the US M2 growth, US bank credit growth, you look at the CRE markets, there are cracks which are visible. As of now, although the labor markets continues to remain tight, but now it is near to the pre-COVID levels. So all these indicators do point that we are near to the rate hike, which even the Fed is guiding that they are near to the rate hike. And as the monetary policy, which works with lags, pays out in the economy for some more time, we think that yields will move lower.
Kaustubh, a retail shareholder today, has the option to invest into SIPs, the equity route, and they've been doing it. The other option that you're putting on the table is a debt fund, this fund of fund, which invests in US treasuries, right? Could you take us through the pros and cons right now to compare between the two? What is the kind of return? If someone invests in your fund, what is the return they should expect?
So, look, as you rightly said, investors can invest directly through LRS cap route. But the problem with LRS is that they have a cap of $250,000 per annum per individual, and then you also have to now pay 20% tax collection at source upfront. Now, if instead of that, if you look by investing through FOF route, which is what we are coming up with a proposition, there are no LRS restrictions which is applicable, which means that in a sense, it is like a normal mutual fund investments. So in a sense, these funds, they give you not only the tactical opportunities that we are talking about for the potential capital gains, they also give you a lot of ease of investments. When you invest directly, you need to buy dollars and then you need to identify a fund. There are a lot of regulatory filings that you end up doing with, that everything is taken care of by our team. On the diversification part also, if you look by investing in these US assets, especially in the kind of geopolitical setup we are in, it makes sense to invest some bit of portion outside the emerging markets, and which is where all these currency hedges and long-term asset allocation do come in.
But Kaustubh, very quickly, last 30 seconds of the conversation, what about the risks? Because when interest rates, move, a lot of bond funds can have a lot of losses as well. So what should investors be aware of so that they don't get whipsawed, given the volatility in US yields?
Look, fixed income investments have broadly three risks, which is liquidity, credit, and market risk, or you can say duration risk. As far as US treasuries are concerned, they are perceived to be a lot more liquid. And from the credit perspective, there is no question being asked, which means that only thing which probably you're also trying to paint is the market risk or the duration risk. Now, as we speak, that has already pushed markets to believe in higher for longer. And we think that a lot of bad news is already being priced in. The fourth risk or potential risk which an investor can expose to is that in case INR appreciate. Now, if you look at last 10 years, generally INR has depreciated by about closer to 3.5% on a CAGR basis. Taking into account that there are potential bond flows which will come in, our base case is that still RBI will make sure that INR depreciate by at least 1 to 2% to ensure that as a country we remain competitive. And in that scenario, it's not only the potential capital gain, but also some bit of currency depreciation gains can also accrue investors at this point of time. And which is why we do think that balance of risk now demands some serious money allocation, especially from a long-term perspective, to invest into US treasuries at these days.
Kaustubh, thank you very much for highlighting the risk and the reward of this particular offering. Thank you for that. We'll slip into a break. We'll come back with more on the market. Stay tuned.